Hi guys, this is Sills, your Central Florida Realtor. Today I'm going to do a topic on how does interest rate affect home buying. Stay tuned. Hey there guys, this is Sandy again. I'm a licensed realtor here in Central Florida, and I want to do a video today on how does interest rate affect home buying. Interest rates are beginning to climb. A lot of people are panicking. We're still in a seller's market in our area, but a lot of people are thinking, can I still buy a home? Or the people who are already pre-approved for a home, do they still have that buying power? If you're pre-approved to buy a home for $500,000, let's say, and interest rates are rising, are you still able to buy this home for $500,000 as an example? Let's dig down into this. Let's find out how does interest rate affect home buying. First of all, and I have to say I am not a lender, I'm a licensed realtor, but because I work with lenders all the time, I kind of have a gist of how the mortgage world works, a little bit of gist, not a lot of gist, right? So I have to declare that. But let's say you're ready to buy a home. How does the whole process work of me getting a loan, and how does interest rate affect me buying a home, right? So when you go to the lender, they're going to do a credit pull, and they're going to want to determine what is your debt to income ratio. That's the first thing. What's the debt to income ratio? Well, the debt to income ratio is your income versus your expenses. Now, of course, they're not going to take all of your expenses into play, but the big expense that they will take into play is all the expenses that are showing up on your credit report, right? A car note, a credit card payment, maybe you have medical bills, student loan. Whatever is on your credit report, they're going to add that up together and they're going to compare that to your income. So let's say you make $100,000 a year, right? And you have $20,000 in debt for the year, then that would be an 80-20. So that'd be great, right? That'd be perfect. So they're going to look at that, and they're also going to look at your credit score. So if you're earning $100,000 a year and $40,000 of that income is in debt, then you'd have a 60-40 debt to income ratio. So this is how they determine this. And they're going to look at your credit score. The higher your credit score, the lower your interest rate, but they're also going to compare debt to income. So you might have a high credit score, but also have a high debt to income ratio. Like your credit score might be 750, but your debt to income ratio may be 70-30. So at that point, they might say to you, you may have to pay off some debt that's on your credit report to get your debt to income ratio lowered, and at the same time would also increase your credit score. Even though your credit score is 750, it's kind of high. It is high. It could be over 800, but it's high. But the debt to income ratio may also affect you buying a home. So this is how they determine this. So let's say the current interest rate, I don't know what the current interest rate is today. Let's say it's 5.5. Before, in 2021, it was low, like it was in the twos. People were closing 2.57, 2.78. I mean, it was really low. So once they determine your borrowing power, the amount of interest rate is going to affect how much monthly payment you can afford. So let's say you're buying a home and the home is for $400,000 and your lender pre-approved you for $400,000 based upon an interest rate, let's say of 2.85%, let's just say. So $400,000, you're pre-approved, your interest rate is 2.85, and then you have a monthly payment at that point of maybe, and I'm going to make this number up, maybe $1,500 or $1,600, something like that. I'm making this up because your monthly payment is going to also be based on how much money you're putting down, right? If you put in 40% down, 20% down, 3.5% down, all this is going to go into play, right? So let's say, for simple maths, you're buying a home for $400,000, you're pre-approved, 2.85 is your interest rate. You start shopping around, you can't find a home. There's a bidding war over here, bidding war over there. You're putting in so many different offers, your offers is not being approved. So now it's at 2.85 and now interest rates start to climb, and now you're panicking because instead of 2.85, now we're at 3.5, as an example. So if you're at 3.5, you got to call your lender now because it was 2.85 before, now it's at 3.5. At this point, you got to call your lender and say, hey, do I still qualify to buy a home for $400,000, and what is my monthly payment? The reason why interest rates is going to affect your home buying is because as it climbs, you might not qualify for the same loan amount, and you definitely are going to have a higher monthly payment, right? So maybe at 2.85, you could buy a home for $400,000. Maybe if it rises to 4% now, you can't, the $400,000 that you were pre-approved for at the 4% interest rate, maybe now you can only buy a home for $350,000, right? And how do they determine this? Like, how do we determine this number? Because the higher the interest rate is, the higher will be your monthly payment, and then it's going to affect your debt to income ratio, right? So if your debt to income ratio was 70-30, you had 70% in income and 30% in expenses, the interest rates start to climb, your monthly payment is going to climb. So then the lender or the mortgage bank is going to have to then say, okay, where's your debt to income ratio now with the climbing of the interest rate, because your monthly payment is going to climb with it. So you were pre-approved for $400,000. Now the interest rate is at, let's say, 4.5. Meanwhile, when you were first approved, it was at 2.5. Now it's at 4.5. That's almost double. Like, it's not completely double, but almost double. Does that mean that your monthly payment will double? No, your monthly payment is not going to double, but it's going to go up by some percentage, right? So, and also to counter that, you might want to put more money down. So if you're in a position where you could put more money down, then that would be great, because then you would then lower your monthly payment even though the interest rates are climbing. Let's talk about someone who hasn't have a pre-approval yet. They're just kind of thinking of buying a home. They're trying to figure out, do I really want to buy a home? Not sure, let me go find out. The higher the interest rate goes, the lower will be your home buying power, because the more will be your monthly payment here's two things that won't affect it. If you're putting cash down, it won't affect it, because cash is cash. I mean, if you're buying with cash. So if you're buying a home with cash, it wouldn't affect it. Or if you have a large down payment, it may not affect it that much. So let's say you're putting 50% or more down as a down payment. Maybe you're buying maybe you're selling one home to buy another home. That will give you more play in the game, but it will still affect the monthly payment. So as the interest rate rise, and now you're going to your lender saying, hey, how much home can I afford? Then whatever it is they tell you when the interest rate was at, let's say, I don't know, 3.5%, I'm making up these numbers, 3.5%, then if it continues to climb, you have to keep in touch with your lender or your mortgage broker to find out what your monthly payment now is and how much do you really are you really qualified for, right? So if you're in the market of buying a home, you may want to buy the home quicker, sooner than later. I know a lot of people are waiting for the crash, and they're comparing everything to 2008, 2009. But guys, we're in an economy that we never experienced before. So nobody knows what's going to happen. Is the market going to go up? Is it going to go down? Is it going to stabilize itself? We have no idea. They're increasing the interest rate to stabilize inflation, right? To kind of control the inflation that's going on. So we don't know how that's going to affect the market. But if you are thinking of buying a home, it's better for you to buy it sooner than later. Now, of course, you're going to say, Sandy, I'm trying to buy a home. I put so many offers in. Nothing is being accepted. What's going on? You're going to have your agent, and our office does this a lot. You're going to have your agent find you an off-market property. Off-market properties are homes that are available for sale that nobody else knows about. Well, how come nobody else knows about it? Because the seller is probably thinking of selling the home, but they're not quite ready. Or maybe they're thinking to themselves, if I get a buyer, I'll sell my home, but I don't want to put on the market. I don't want the big rush, right? This is the reason why investors are able to buy homes directly from homeowners. Zillow had a program recently, they closed it down a few months ago, where they would go and they buy your home for cash. How did they know you were selling your home? Because they advertise it and you call and say, hey, I'm thinking of selling my home. Now, were they giving you full market value? No, they were charging you a convenience fee. They were charging up to a 15% convenience fee, right? So if your home was really worth $500,000, they're going to minus 15% from that. Way more expensive than using a real estate agent, I'd say, but people are doing it. So if you work with us, our goal is to find off-market properties in this market. We would literally go out to the communities and find out who is thinking of selling their home. And if one of our buyers say, hey, I'd like to live in that community over there, we go over there, we ask all the homeowners over there. And yes, we have their information. We send them a letter, email, text, whatever we need to do. Here we have a buyer, they're thinking of buying in your community, or are you thinking of selling? Whatever the seller says, yes, we're thinking of selling, guess what? We connect the buyer with that seller, boom. There's no bidding war, and there's no drama, and there's no, oh my God, I just put 5 offers in on 5 different homes and none of them was accepted. So, since interest rates are rising, if you're really serious about buying a home, then now would be the time to concrete that and to find that home, whether it be an on-market property or an off-market or unlisted property. If you're working with a realtor, ask your realtor, hey, can you find me some off-market property? Can you find me some properties that are not on the internet, so I'm not competing with all the other buyers on the internet, on Zillow, Trulia, Realtor.com, or even on our MLS system, okay? So I hope you're able to get some information from this. The reason why interest rates will affect your own buying, and as interest rates start to climb, and I don't know how far they're going to go, but as they start to climb, it will affect your buying power, because it's going to affect your monthly payment, which plays into your debt to income ratio, which plays into your borrowing power, right? And also, if you're putting little or no money down, or less than 10% down, if you put in 20% or more down, you could play around with the numbers. It still is going to affect it, but not as much as if you're putting less than 20%. Because if you're putting less than 20%, you got to play with PMI. Not only would you have a higher interest rate, but now you got to pay mortgage insurance. What is mortgage insurance? Mortgage insurance is an insurance that you pay when you have less than 20%, when the bank is lending you less than 20% of equity in the home. So that means if you're buying a home and you put in less than 20% down, you're going to have less than 20% equity in the home. So if you put in 5%, 10%, 3.5%, 15%, anything lower than 20%, then you're going to have to pay mortgage insurance. The good news is, as the property appreciates and starts to go up in value, and you get that 20% equity in the home, you can call the bank and get the PMI off. Okay? So I'm not going to make this video any longer. Thank you so much for listening. Again, I'm Sandy Sills. I am a licensed realtor here in Central Florida with the Giff Group, and I thank you so much for listening. I can be reached. If you have any questions, you could call or text 407-791-4713. Thank you guys. I'll see you in the next video.